back now for an update on the fixed income and money market. I'm now being joined by Thaddeus Udegbe, fixed income trader. Thank you so much, Thaddeus, for joining us. Now we're looking at, of course, a new development at the markets. The Monetary Policy Committee, we saw, of course, the MPR kept at 12%, but of course there was a surprise introduction, the 50% cash reserve requirement on banks' public sector deposits. Now, first of all, let's look at the impact that could likely have on bond yields at the market.
First and foremost, let me take you through the decision that was taken today. This was 11th Monetary Policy Setting meeting. After the last policy rate hike was done in October 2011. At that MPC, CBN, at today's MPC, the Monetary Policy Committee maintained policy rate at 12%, which is in line with expectation, which is in line with market expectation. Liquidity ratio was, of course, maintained at 30%. Net open foreign exchange limit was maintained at 1%. CRR was maintained at 12%. However, the big surprise today was the 50% CRR on public sector deposits, and therefore CBN cited good reason why it's taking this decision. We cited the case of high cost of managing liquidity in the system, which was the basic reason why the 50% CRR on public sector deposit was introduced, so as to help CBN manage the cost of managing excess liquidity. You will recall that since January this year, we've seen high liquidity into the system. We've seen a huge expansion in liquidity in the system. For instance, in January, we had CBN mopped up in over 1.5 trillion naira in excess liquidity through open market operation, and that continued up to date. And if you look at the total outstanding open market bills in the market, you find that it's close to about 4 trillion. Which means that the cost of managing liquidity in the system is very high. So
now Thaddeus, if there is going to be an increase or a hike in bond yields, how soon will we see that happening at the market?
Yeah, typically this is a surprise to the market. Of course, if you look at what happened today, you find that there was a huge rally on both treasury bills and bonds. On the average, we saw yield for the bond, the lowest tenor trading at 13.1%, while the highest tenor traded at 13.5%. On the treasury bill side, we saw the 91-day bucket traded at 11.9% yield, while the one-year bucket for the treasury bill traded at about 13.45%. However, this big surprise will be interpreted tomorrow by market players. I expect to see a spike in yields across all the maturities, both treasury bills and bonds, as players begin to factor in the tighter liquidity that we are going to see in the near term. Of course, we expect to see cost of bank borrowing increase, as most banks that are dependent on public sector funds will be negatively impacted, as they will begin to source for deposits in order to meet their CRR obligations to the central bank. And of course, the pressure on some banks to sell off their assets, treasury assets and bonds, would of course put pressure, downward pressure on prices, and that would reflect in high yield, which we expect to see in the coming weeks.